Hello guys, and welcome back to another video in my channel Order Flow with Ethan. So this is a section 32 of this channel. Liquidity isn't what you think. Order flow explained simply. So welcome to this video where I will explain the concept of liquidity and how does it work. So trading the order flow is different than trading candlestick charts or any different type of trading. This is something I really want you guys to understand, because there is a very big difference between trading the order flow and trading your traditional chart. Here you have much more insights than your normal trading. As you can see, you have lots of numbers here that gives you better knowledge and better information about the market, from deltas, max delta, mean delta, and all of these imbalances you have through your chart. So this is why it gives you a better edge in the market. So what is liquidity? Liquidity is just buy orders waiting to be filled and sell orders waiting to be filled. Thing that you can see here, if you see how the market went up, then you have all of these stop losses being hit at this point, and then the market going down. So these are, well, sell orders we can say getting filled, but the market still went down, or buy orders getting filled and the market went down, because those were stop losses of people. So one thing to know about footprint charts: passive liquidity, it's when orders wait in the system. When we have limit orders, limit buys and limit sells. So limit orders, and we explained this in the very beginning of this channel. So limit orders and basically orders are waiting to be filled somewhere in the market. You're not buying at the price the market is offering you now, but you're waiting for the market maybe sell at a higher price or buy at a lower price, because as you can see in the futures market, price is not stable, it's horizontal. So 145 goes against 365 buyers and 145 sold contracts. Active liquidity is orders that hit the market. It's market buys and market sells. People that buy into the market now with the price being offered now, and people selling into the market with the price that's being offered at the same moment. So where can you find the liquidity? It builds in predictable areas. First of all, previous highs and lows, because traders place stops there. 2. Breakout zones, because retail traders enter late and place in stops nearby. Third of all is range boundaries. People assume the range will hold forever. And fourth is obvious support and resistance. The more obvious it is, the more liquidity it attracts. And this is basically the market. When the market goes back to previous highs and lows, that is why we call them support and resistance. Traders always put their stops there, and there's liquidity that the market should take. And also breakout zones, because those retail traders enter late here, for example, they want to go back here again, they want to sell here when the market goes back to the same level. And yes, obvious support and resistance is basically previous highs and lows. And range boundaries, people assume the range will hold forever. When the market goes, people here maybe they thought the market will bounce back again and go up, but it's not what happened, and that's where we found liquidity here to move the market down. So the first step of liquidity is building up. Like, price moves into a key level and starts consolidating. For example, here traders do two things basically. We have breakout traders that enter too early, they get too excited, they want to sell too early, and counter traders short or long too early. Okay, then we have a step 2, which is expansion. Price suddenly spikes into the liquidity zone, so the price goes back to gives us a small correction, and it looks like a breakout above resistance or a breakdown below support. Then step 3 is the execution. So here the market went down basically, as you can see. So we had this market going up to this level, went back for a small and quick correction, and these stops become market orders. This is where the market goes down, and as you can see, the market basically is giving us lower levels again. So what happens? Buy stops are triggered, add market, which means market buys. Well, sell stops getting triggered, that's market sells. So remember this buy stop triggers, it's the one we have here. So maybe these people sold here and did their buy stop, and they're being hit here. Maybe they sold here, they waited for the market, they gave this stop loss here, they didn't leave the market yet, went back, correction, went down. So this is basically the setup that's happening in this exact level. So as you can see, those stops become market orders, and the market basically goes down. Okay, so it happens when buy stops are triggered, which means market buys, and when sell stops are triggered, which gives us those market sells. So this is where the order flow footprint charts become actually really powerful. Why? Because first of all, it shows you who is actually aggressive, who is absorbing, and who is getting trapped. So here we can see people getting trapped. We can see the buyers being absolutely aggressive here. Here we actually don't know. I mean, yes, it's obvious from the result, but we don't see all of these stacked imbalances and all these exhaustions happening all over the market going up. And then why did the market go down? We can see that we had trapped orders here. We've had people with liquidity that made the market go down. We've had stop losses being hit at some point, but we cannot see that on our candlesticks because they only show you the wick, the breakout, and the fake move, and this potential direction because of some bullish, harami, or whatever. So this is why there's a big difference between using the order flow. Also, you have much more confirmation zones, such as your delta, max delta, min delta, imbalances, POCs, single prints, exhaustions. All of these concepts can be shown through the order flow. So guys, here you can see why retail traders always get trapped. They trade breakouts, support bounces, and obvious patterns, but they ignore where stops are sitting, where liquidity is stacked, and where liquidity is being collected. So the market is basically going through the concept of liquidity. Go up, get liquidity, go down, get liquidity again. So there's liquidity sweep that happens every time. They enter right before the sweep or during the sweep, which makes them the liquidity. And you shouldn't be that liquidity. So stop trading breakouts, stop trading support, bounces, and obvious patterns, because they're basically patterns that are shown to everyone. And if it was that easy, it wouldn't be that easy to make money on trading. And yes, they ignore where stops are sitting. If many people have their stops here, the market will eventually go there to trigger their stop losses, and then it will go down. And you see it still went up later because the reason was just getting those trap traders out of the market. That's liquidity. The market always needs liquidity to keep moving. So thank you so much for your time watching this video. I hope to see you in the next video, and if you have any question, please do let me know in the comment section. This was Ethan from Order Flow with Ethan, and thank you for your time.